Assalamu alaikum. Good afternoon, everyone, and thank you all for joining us on today's venture stage. I'm excited to moderate today's session on navigating valuations and exit. For those of you who don't know me, my name is Mohammed Ibn Ali. I'm a part of the Hub 71 mission. I lead on the value creation, focusing on the capital ecosystem, where I sit between the startups and our capital partners. For today's panel session, we have great panelists that joined us to share their insights. We have Dr. Bilal Balouch, who's a partner at Shuruq. Shuruq, for those of you who don't know them, they are maybe one of the first VCs to set up an ADGM, and now has grown to have multiple offices in the MENA region with multiple funds between debt and equity. We also have a close partner from Nua Capital, Khalid Talhouni, who's a managing director of Nua Capital, as well as a very close partner to Hub 71, and again, one of the earliest VCs to set up and really continue to fuel the MENA ecosystem. Thank you both for making the time to join us at Abu Dhabi Finance Week. I'd like to have it an open discussion. Really, I'll go back and forth between you and Khalid to really understand your perspective as investors when you're looking at valuations and exits. But before we start with the topic, maybe we can spend a few minutes with an intro on the great work and what you guys do at Shuruq and Nua Capital. So maybe Dr. Bilal, you can start off with you.
Yeah, thank you so much. It's a real pleasure to be here, and what a wonderful few days. Abu Dhabi Finance Week was the first conference that I attended last year when I first moved here. I see it more as a festival of ideas, and that's clearly been evident in the different sessions that we've had in the last 24 hours. So a bit about me very quickly. I'm an accidental VC. I come from a background in international politics and consulting, but in between that world and this one, I founded a company in Washington, which was in the market intelligence space called Inquire AI. So much of being a founder is being in the right place at the right time in terms of industry, stage, and the years during which I founded my company, which was a real boom for tech and venture. It was a great time to build a business, which I then scaled from the US to Asia, specifically Japan. At Shuruq, we are one of the region's leading early stage tech investors. We invest in fintech primarily. That's less to do with thesis and more to do with where some of the most exciting solutions are emerging in the region. But we're also investors in biotech, ag tech. For those of you that live here and have tasted Pure Harvest's delicious tomatoes and strawberries, we were one of the earliest investors in Pure Harvest. And mainly we're focused on B2B. As was mentioned earlier, we do private credit as well as venture capital, and have an ambition to be a multi-asset, multi-strategy firm. And it's a pleasure to be here.
Thank you. Khalid?
Oh, thank you very much. And as Bilal said, it's a real pleasure to be here at Abu Dhabi Finance Week. It's always great to see old friends. And thank you to the Abu Dhabi Finance Week team in bringing this together. A little bit about myself and Nua Capital. So I've been in the early stage venture capital space for about 17 years. Set up Nua Capital in 2000. We set up Nua Capital, in 2020 and launched our first fund there in 2021. Before that, I'd been in the kind of VC ecosystem for a long time, mostly as an investor, focused on the GCC, North Africa, Turkey, and a little bit in Southeast Asia and Sub-Saharan Africa. Some of the companies invested in previously include, Kareem, which I'm sure you all know, like Mum's World, a Turkish company called Insider, which is kind of one of the biggest successes we've ever done. And then out of Abu Dhabi, one of the biggest successes I've ever done was a company called Jawakir, which is an early stage gaming company set up down the road in 2010, if you'd believe it, sold to a Swedish gaming conglomerate for about 100x. So I think one of the first kind of big stories to come out of Abu Dhabi, and 2454, which is down the road from here. In 2021, as I said, we set up Nua Capital. We are primarily an early stage venture firm. So our bread and butter is seed to Series A. So we do tickets of $500,000 up to $3 million at entry, and then we follow on over time. We then also, similar to Shuruq, have a kind of private credit offering through a joint venture with another asset manager. And then we also do some late stage investing on a deal by deal basis. So we also kind of build syndicates around Series B and beyond. We're sector agnostic, so we look at anything that's disruptive and has a large addressable market, and our kind of core focus is this geography.
Thank you, Khalid and Dr. Bilal. I think today's discussion is really focusing on navigating valuations and exits, right? And I want to cover mainly two topics, right? When or what founders should be thinking from day one on exits, and how they should navigate to reach that exit, right? And I'll start off with you, Dr. Bilal. When should a founder really think of an exit, right, or valuation? Starting a business is already challenging. They're solving big problems. When should they think about it? From day one, or when does that come into place?
Look, this is a very important topic. Let me just put in a shameless plug that we at Shuruk recently brought together some of the leaders of the ecosystem here to talk about exactly this topic, mainly around exits, supported by ADGM, and we did that in conjunction with the London Stock Exchange. And the report is out now, as of a few days ago, on our website, shuruk.com, so do download it. To my knowledge, it's the first report of its kind that does a deep dive on what is needed for IPOs and exits, and how can we as an ecosystem fuel more of them in our region. The short answer is founders need to be thinking about exits right from the outset. And part of that is also to be thinking about how venture capital works. As a former founder and now being on the other side, one of the things that I think is, good founders think about the science of valuations, and good investors think about the art of valuations. And what that means is, as a founder, as you're navigating your journey and going into the market, you really need to think deeply about what is the mandate that's been given to the VC that I'm looking to have lead my round. Who have they raised capital from? What is the mandate of those LPs? What fund number is my investor on? What kind of time horizon are they looking at? And what do they expect in terms of returns on capital from the investments that they're making? Far too often, founders don't concretely consider those variables and think far more about their own performance, and can end up being quite inward-looking and within themselves. And so exits and how exits come about is very much important right from the outset. Now, given that the public markets here haven't thrown out as many technology IPOs that we would have liked, a big piece of that is going to be how am I positioned for an exit vis-a-vis an M&A. And so thinking very concretely about who your potential acquirer targets could be, who your potential merger targets can be, and not being necessarily explicit about that, but thinking that through and pegging that to how you think about your market size is absolutely crucial. Hopefully in the years to come, and hopefully in the very near term, as the capital markets here deepen, that should then also include your pathway to an IPO. So, hopefully we will see probably 3 to 5 technology companies going public in the next 18 months. We haven't even seen 3 to 5 in the last 10 years. So those are some of my sort of high-level reflections on how a founder can think about these variables right from the outset.
Let me just add to that. I think I disagree slightly with that idea that founders should be overly concerned with exits. The exit is a byproduct of building a great company, rather than the other way around. So actually, I think for me, if I meet an early stage founder, especially early stage, as you go on it kind of along the spectrum of the development of a company, then that changes. But if I meet a seed stage founder and he's talking overly about the potential exit opportunity, 9 times out of 10, that's a big red flag, because the principal driver of a successful outcome is really building a great business. You don't try to optimize your business for an exit or design it for exit. Sometimes you're able to do that, and some founders are able to pull that off. But that's not how truly great companies are formed, right? Great companies are formed when founders are obsessed with a huge problem that they want to solve in the best possible way. The exit is an investor concern. This is our concern. We worry about whether the capital markets are there, whether M&A opportunities are there, etc. And the founders should deliver that for us because we took the risk at some point. But the founder themselves being overly obsessed with the exit outcome versus actually building a great company is a major red flag. And I encourage founders that I think like that to say, really, are they really want to build a company, or they want a big financial outcome they should come together, but the path to it is starting with having a great business first, building a great business first, and then going from there.
And kind of wearing the investor hat, right? And both of you do early stage investments. Do you put the exit opportunity a part of the due diligence, or this comes down later on?
I mean, if a company it is part of it, but I think whether a company is exitable, quote unquote, I think forecasting that is very hard. I think again, going back to the kind of first principles idea, which is you want to invest in a company that has great founders, building a great product, solving a massive problem in a big market. And then the exit will come. So to give you an example from my kind of history. So like when we invested in Careem years ago, there was no exit opportunity. If we due diligence, actually, I remember the investment committee meeting well, and I can show you my IC memo. We said, can we invest in Careem? And we had external IC members, non-team members. And they're like, who's going to buy this? Where are you going to list this? What are you going to do with it? But the fact that the business was growing so quickly with a fantastic team, I think spoke to the fact that if you build a great business, the liquidity will come. Especially in markets like ours that are nascent and underdeveloped, where if you take a moment in time today and you try to say, what is the exit opportunity going to be in 7 years? The nature of our economies generally are so in flux and so on a kind of evolutionary trajectory. I think it's impossible to kind of forecast that well. I think the principal element, back to the question before, is build great businesses, ultimately profitable businesses, and there's always going to be a buyer or an exit path for a great company, always.
It kind of brings me into the second discussion, right? Valuations. A lot of founders today think the higher valuation they get, the better success they might have, right? What are your thoughts on this? How can you support founders on having more realistic valuations that support their kind of growth as well?
Yeah, so look, I think a founder is trying to optimize for dilution, how their business is viewed and valued, and it's something that's not just a business decision, it's also something that's very personal for them as well. I think it would be quite worrisome if a founder was focused purely on moonshot valuations without rooting it in a specific rationale or logic. And that's where, to my point earlier, understanding how a venture capital investor thinks about the market, about returns on capital, how their LPs are mandated to think about these issues as well, is important for how the founder is able to articulate that message. Of course, there are structural variables there as well around the potential of their market, what other case studies have looked like in their market. So to the Careem example, you had the small matter of Uber also existing around the world, Halo doing very well around the world, in London specifically, and other examples as well. So, there's more to it than just, what your own performance looks like. If a founder is just focused on valuation alone, just as a matter of form, no, of course not, because it has to be a matter of negotiation as well. But the entry point on trying to optimize on valuation by virtue of trying to minimize dilutory effects now and in the future, as an intention, that I understand that, right? I've built a company myself. It's something that you feel very deeply and personally, but the other side gets a vote. And so it has to be a matter of negotiation. And so I wouldn't call it a red flag. I think there's very few sort of very stringent red flags. It's a matter of negotiation, but it's certainly an amber flag if a founder is not willing to budge, and they certainly don't have a rationale for how they're interacting with the investor.
Yeah, I think I agree fully with what Bilal is saying. I think the valuation is a very, very imperfect analog for success. So I caution a lot of founders from kind of falling into that trap of saying, if I optimize or maximize rather my valuation, then that is a leading indicator of the success of my business. And that's not always the case, because ultimately, the price of equity of your firm, your valuation, is just a function of supply and demand. If there's a lot of capital in the market, right, then it's low. If there's a lot of demand for your stock, then obviously it goes up. But I think the caution here is, within the context of your fundraising journey and your capital requirements over the long term, it can actually be quite destructive to push the valuation beyond what is kind of necessary. Because what it does is it doesn't account for fluctuations in the market over the long run. So if you're able in a kind of a period of high valuations generally in the market, push your valuation quite high and maximize for that, then that's great for you in the moment because you limited your dilution, you raised money, but it creates pressure on you 2 years down the line. If the market is less frothy, then suddenly you're on the wrong side of that trade. And if you haven't grown into your valuation and exceeded it, then you start, for your next fundraise, you're put in a very, very precarious position with respect to raising the next one. Because if you're underwater, investors will run a mile. They don't want to deal with, a company that's not lived up to its valuation expectation. It's too messy to do a down round. People do it, but if it just creates pressure that you don't need. So there is a balance here somewhere. And I think, yeah, just the principal element being not to think of high or relatively high, whatever that means, high valuation as a stand-in for success. There are many, many businesses here globally, and everybody knows their stories, that you raise at high valuations, but that doesn't mean ultimate success. Success is building a great business that ultimately is profitable, that delivers a lot of value to your stakeholders, customers, and shareholders.
I think a lot of founders, don't differentiate between valuations and profit, right? A healthy cash flow is much important than just running and going for that high valuation. Maybe to the second point, it's more on, there's in the region, in the MENA region, there's a lot of incentives, programs, rebates that a lot of these startups can get. Do you think it affects their valuation as they get these rebates and incentives? Is it on the good side and the bad side? Do you, as investors, promote your portfolio companies to access, either Hub 71, the investment office rebates? And, there's a lot of programs happening.
Yeah, I think I'm going to say two things at the same time. So I think on one level, I think these kind of incentive programs can be quite accelerating to a sector rather than a company. So I think of it like more if you want to kind of push electric vehicles, for example, you give rebates around kind of energy prices there, stuff like that. That could kind of help support an overall sector. And those can be very, very effective if structured the right way. So they have this impact of being an accelerant on a sector or kind of an industry as a whole. I worry a little bit about companies that, responding naturally to an incentive, contort themselves sort of very unnaturally just to get the incentive, because companies that do that kind of just try to do anything just to get the incentive probably is not a great company to begin with. So if the incentive is incidental to the journey of the business and is mostly just kind of like 5-10% move on the performance of the business, then that's fine. That's great, actually. But it's very easy for companies just to pursue an incentive just to kind of get the cash, and that's a very worrying sign when companies go in that direction. And you see this all over the world, and it's a bit of a balancing act. Like, how do you kind of advise companies to make use of these sort of accelerants in a positive way without becoming overly reliant on them? Valuation-wise, any company that is heavily reliant on incentives, whereas a good chunk of their OPEX, for example, is reliant on a single point of incentive, that's a red flag. So we would be worried about that. But if it's incidental, like I said, and just merely incremental, then I think that would be a net positive generally.
Yeah, and just to speak to the other side of this, because what Khalid said, I think, is pretty spot on. The availability of these incentives, I think, is fantastic for the startups, and hopefully there should be more and more so that contortion act doesn't need to happen. So we're seeing more and more, for example, incentives for companies that are in the biotech space now, right? Being able to get access to labs, being able to get access to grants, being able to get access to collaboration opportunities with state-run entities. I think this is all really valuable because it's the equivalent of speeding up your go-to-market for a biotech company who, unless they're a platform, it can take a long time to get those opportunities. So from a supply side, Hub 71 being another one, the availability of these incentives is it's an important marker for the deepening of the ecosystem.
I mean, just to add kind of to that, it's like where you see incentives and these types of programs working very well is when they are addressing a core market failure to kind of fix the problem. So the labs example is a great one. If there are no kind of infrastructure in the form of biotech labs available, soft loans or kind of incentives to get those going enable a wider ecosystem. The ones where I'm always slightly cautious about is when they're super targeted on a company, like underwriting OPEX. And that can work, and I've seen great examples of that working. But a lot of the times, it sort of has a distortionary effect rather than a net positive effect.
Yeah, we had a similar experience, right, as Hub 71 when we launched initially. It's all about packaging it the right way and the right sum. You don't want the founders or a startup to feel too comfortable on incentives and being too slow compared to having the right incentives, the right milestones to achieve. Dr. Bilal, I want to come to you. I think it's more on comparing, the US market. You lived in the US for quite a while and now in the MENA ecosystem. How do you compare the two, especially with the US being a hot market, especially for exits, right, an IPO? How are you seeing the MENA or the UAE kind of compared to the US?
Yeah. So I think, Khalid mentioned earlier, when you meet an early stage founder, if they dive too deeply into talking about, well, here's how we're going to get sold 7, 8, 9, 10 years from now, as an investor, you think, well, why are you even focused on that right now, right? Focus on your business, build your business. I think that's one of the big areas that separates out the US market from here. While the narrative of hearing that from your founder is probably not something you want to hear outright immediately, but the reality is in the US, the variable of exit opportunities is a constant. They're there, right? You could be bought out by a regional company and competitor. It doesn't even have to be a household name. I sold half my company to a Japanese conglomerate because the US market is attracting constantly companies that want to tap into its innovation. There are capital markets vis-a-vis the known entities like the NASDAQ stuff as well, but there are also nano markets, micro markets that you can go and float on. There was the SPAC opportunities, although they have a patchy history. There are so many ways to quote unquote exit your enterprise and create liquidity for yourself, for your talent, for your people, for your investors, that you can explain away that part. And so when I was building my company, I wasn't really focused on exits. I was doing what Khalid said. I was focused on trying to solve a puzzle, build the business to the best of my ability and those of my co-founders, and win, right? Because the odds are stacked against you no matter where you build a startup. I think here, founders do need to be a bit more acute. They need to be acute to not just exits and valuations, but they also need to understand the regulatory environment in which they function. I think 40% of our portfolio is in fintech. I expect my founders, with our help, but also independently, to firmly have a handle on what does the regulatory environment look like in this market that they might be in. Tomorrow, if they want to go into Egypt or Saudi Arabia, what does it look like for payments? What does it look like for integrations with banks? What does open banking look like, etc.? I expect them to have a firm grasp, again, independently, with us, etc., with the ecosystem, on their competitive environment. Who else is doing what they're doing? Not to suggest that it's a zero sum, because we've seen in many different industries now, there's a mushrooming of prop tech companies, a mushrooming of expense management companies, etc. But you have to have a much more acute understanding of that than you would say, for example, in the US, because I can win as a regional player or even a state level player. I don't have to be pan-US. So these are some of the sort of more tactical elements as it relates to exits. I think that's going to change here. I think one of the big shifts outside of the changes on the sort of innovation and pipeline side is the emergence of Saudi Arabia as well, right? So now you have a sort of a competitive environment when it comes to exchanges and capital markets in the region. You have options. I hope the exchanges can come together and rationalize some of the norms and laws around their exchanges so that companies can navigate it better and perhaps one day even dual list, which would be great. So I see it changing, but that's, as things stand, those are the sort of sharp contrasts.
Yeah, and I think these are the incentives we're working on, right? How can we create incentives to support potentially high growth entities to tap into the IPO market and ease up the process for them? Khalid, I want to ask you on your side, right? And we mentioned this a bit earlier on due diligence, right? From an investor's perspective, how does due diligence play in valuations and exits, right? How deep do fund managers go into it as they're investing into startups, either from an early stage, or when do investors really look at exits and
Yeah.
valuations?
No, awesome question. So I think for us, it is a spectrum. So the earlier the company, on the kind of on its kind of development scale, so pre-seed company, for example, the less the valuation matters if it's within the general bound. So let's say, I'm just throwing out numbers. So let's say seed companies, pre-seed companies, very early, anywhere from 5 million to 15 million, or 20 million even, or as low as 3 million. It's not going to matter much, because what you're underwriting for is possibly a 100x outcome from there, or a 50x outcome from there. So if you're off on that first check by 10, 20, 30, 40% on the entry value, even 50% on the entry valuation, you have a lot more latitude to be wrong, let's say, right? As the company evolves, and as you're looking at a company that's more developed, so like at Series A, then that window of latitude is closing, right? Like it starts kind of narrowing and narrowing and narrowing. So by the time you're at like a Series B company, or a Series C, especially in the region, if you're in a Series B company, you're looking at something in the $100 to $200 million range. Then you're saying from there on out, realistically, what is the possible exit outcome? Because if I'm wrong by 30%, I could end up in a situation where I'm underwater. Actually, I did everything right. I picked the right company, I invested in the right business, but actually the exit didn't live up to what it didn't work for my underwriting. Great example of this is the last round of Souq.com, for example. The investors picked the last investors picked the right company, etc., and they just mostly made their money back. So even though like they picked the right company in the region. So I think that's because it's at the late stage. So stage really matters when it comes to looking at the entry point. The other really important thing is we obsess about the entry point, but actually we should be thinking about the exit. So valuation, to demystify it, is really just accounting for the potential size of the exit outcome and risk adjusting that and working that backwards. That's all you're kind of really doing. So the number at the forefront is not that meaningful. What matters is if things go well, can this give me 10x from here, 20x? Is it possible? If so, at 500 million, no problem, right? If it can give me 20x from there, I mean, what's the problem? It's really assessing that potential that matters, not so much today. Even though as human beings, I think it's hard for us to internalize that. And even though I'm saying that now, but actually in the moment when we're looking at companies, it's very hard to kind of revert back to that type of thinking, because you're kind of ascribing a value in the future that's far away based on today's data, and that's very hard to sort of conceptualize. I mean, the kind of our brains have not evolved to think like that. They've actually evolved to think in the moment, right?
Yeah, thank you for that. Sadly, we're running out of time. Would love to continue this discussion, but hopefully next time. That's it for us today. Thank you, Khalid. Thank you, Dr. Bilal, for joining us today at Abu Dhabi Finance Week. Great to hear the continued success and growth at Shuruq and Nuwa Capital. Thank you all for joining us today at Abu Dhabi Finance Week.
Thank you.